Welcome to the Real Estate Show this weekend on KMED. Pete Belcastro and Joe Brett, the real estate guys, with you. One of us anyway. Joe's off visiting family this weekend. We'll be back next weekend, 4th of July weekend. Can you believe that is upon us? And hope you're going to have something positive happen that weekend. It's always Friday. I like the 4th on a Friday. Makes it for a nice long holiday weekend. Hope you're going to enjoy that as well. We're talking today with Glenn Cunningham here on the Real Estate Show. Talking about the end of the fiscal year, tax returns are pretty much all in already, but businesses and people who are doing things, this is always an interesting time. Governments love the end of the fiscal year. When I was at SAU, they just couldn't wait till June 30th got here because they could start the new year. You started new money, on July 1st. You got some new money. And, of course, the private sector doesn't quite work that way, Glenn, does it? But
no,
I wish it did.
No, Pete, it doesn't. You don't have all the manna from heaven falling in your lap at one time in the year. But there have been some benefits as a result of changes to the tax code. And one of the greatest ones that I'm most excited about, and many of my clients are excited about, is the new Safe Harbor Office in Home.
Safe Harbor Office in Home. Okay.
Yeah, it's a different way of deducting the expenses of working from home. So you're self-employed, and I know that you've always been reluctant to take the office in home deduction.
Well, I've always been reluctant because people like you say that's a red flag to the IRS. Well, if you're using your home for that kind of thing, and it's legit, but you don't want to draw flags. That was my always thought.
So there are a number of things that cause someone to have a potential higher risk of being audited. One of them is being self-employed. Well, you're already guilty of that.
You already have that.
So in a lot of ways, you are already there as a self-employed individual in that pool of people who might be examined a little bit more closely. Having an office in your home, if it has a legitimate business purpose, you regularly and exclusively use it for business, allows you to deduct expenses that you wouldn't otherwise be able to deduct on your home. You're a homeowner, you pay property taxes,
right?
You pay mortgage interest. Both of those expenses are generally deductible on your tax return. But you also pay utilities, you pay for the maintenance of your home, you pay for trash, you pay for improvements in the home. And those are normally personal expenses and you're not able to deduct them.
Can't deduct those. Okay, right.
But if portion of your home is regularly and exclusively used for business, you are able to deduct a portion of those expenses that are, in essence, dedicated to that office and home.
So, for an example, your office, is it done by square footage or is it done by, how do you measure or how do you, figure out what is the actual office space and how much can I deduct from that then?
It's relatively simple.
Okay.
You could
relatively simple coming from CPAs is not relatively simple, I've learned. Okay,
well, it uses a tool that's not usually part of my arsenal, and that's a tape measure. And you essentially measure
the room.
Measure the room.
Like you would for square footage in a house. Okay.
Exactly. And it doesn't even have to be an entire room. If you have a desk area that you use regularly and exclusively for business, you measure this amount of floor space that the desk and the chair take up and your computer and your printer. If that's 10% of your home, that means that you're able to deduct 10% of those expenses.
Of the utilities,
trash,
the trash,
repairs,
etc.
Against business income. And for a self-employed individual, that has tremendous benefit because it not only reduces your taxable income, but it also reduces your income subject to self-employment tax.
Now, many people who I show property to, one of the things that many look for is an office. Okay, now I don't know if they're working in the offices or what they're doing, but many people, as you know, Glenn, work at home. That's got to be a growing trend. So many people I see work at home.
Well, one of the unfortunate consequences of the fiscal meltdown of 2008 and 2009 is that a lot of people who were formerly employees suddenly get told by their bosses, you're no longer an employee, right. You're an independent contractor, and you have to work from home.
So I would fall into that category.
You would indeed.
Yeah, absolutely.
Yeah,
okay,
yeah.
All right. Yeah.
So there are a lot more people working out of their homes. And with this new legislation, there's an opportunity to take the office and home deduction without going through all of the bookkeeping that might otherwise be required.
So that's the change, maybe, is that?
Absolutely.
Okay.
So one of the reasons that you've decided not to do it is you don't want to track your utility expenses. You don't want to keep track of your home repair expenses. But with this new Safe Harbor office and home, let's say that your home office is 100 square feet.
Okay.
Okay. You get $5 per square foot as a deduction. So 100 square feet times $5 a square foot, that's a $500 deduction. You get that $500 deduction on top of your mortgage interest if you have one, on top of your property taxes if you have one, and that $500 deduction you can take off your net business income if you have a home office and you regularly and exclusively use it for business. You don't need to track your utility expenses.
I see. Okay.
That
makes sense, doesn't it? Do you expect more people to do this?
I have found in some cases there are clients where the Safe Harbor office and home is a larger deduction for them than they might otherwise be eligible for.
Okay.
And I certainly encourage those clients to do it. And then other clients who were interested in taking the office and home deduction but didn't have the mind for or the time for the paperwork, they made the decisions to do this instead. And it's really been beneficial for people. And the great part about it is it's not an added schedule to your tax return. It essentially is
it's just
one
part
line.
of the return, one line of the return now.
It's absolutely
well, that has really changed. Well, certainly that's one of the advantages, and hopefully people will do that because so many of us do work at home and measure the space. It might be, I think I measured mine was like 200 square feet out of 2,000. Would be, how much is that? 10%, isn't it? That doesn't, about 10%.
So and I don't encourage people to do one or the other method. I think you need to do the analysis. A key part of the office and home deduction is the fact that you can expense parts of your home. And if the expense is greater by taking the Safe Harbor, you're entitled to do that. And I want people to be able to do that because it means less income tax. And remember, you're only required to pay as much income tax as your taxable income demands. And if you have legitimate ways to reduce your taxable income, you can reduce your income tax.
Absolutely. All right. We talk a lot in our shows over the years of renting versus buying. You know, when we started our show 5 years ago, it seemed like buying was a real smart thing because prices were low. You know, the things as the markets go and change. What now? Is something changed that because it flip flops and now maybe those affordability indexes change and those kind of things. Is it still today? What's the advantage? Is there still that advantage that we have told people for so long? Of owning your own home versus renting, what's changed? Why is that? What's the deal with that?
That's a great question, Pete. It depends, and I know I give you that. I give you that answer a lot, but it really does depend. And before I talk about the economics, I'm going to talk about the things that are not economic, the things that you need to consider that aren't going to be answered by a spreadsheet. Those factors are how much value is there to permanence for you? Permanence is one of the things that you can generally get by buying a home. You don't have that with a rental situation because your lease is a year or 2 years, so the landlord can make a decision that takes the control of your using that home out of your hands. So if permanence is important to you, that's one thing to say, well, maybe home ownership would be more important to me. How confident are you that you want to stay? If you have a track record of changing jobs and changing locales every 3 to 5 years, you may not think that the best decision to make is to buy a home because you're not planning on being there long enough potentially to take advantage of any appreciation in the property.
Because that's the key. I mean, as far as you're concerned, you want to be able to depreciate your property, right? That you buy over time.
You want it to appreciate. You want it to increase in value. That's a critical component in making the rent versus buy decision.
Wasn't it one time people would stay in their home on average? It was like 7 years, and that's dropped, hasn't it?
It certainly has.
It's not that long anymore. So, what is there a number of years, Glenn, that you would can I guess tell us regarding as you should live in the property before you would want to sell it? I mean, I see people buy stuff and sell it in a year. at a loss or no money kind of thing.
Well, for the average consumer, Pete, the costs of buying a home and selling a home are unbelievable. So, if you think about the costs of closing on a mortgage, you could be paying between $5,000 and $10,000 to close on a mortgage. And then if you're when you're purchasing a home, and then if you're selling a home, the average realtor commission is anywhere between 5 and 7%.
Mm-hmm.
So 5 and 7% of the value of the home, if it's a $200,000 home, that's $14,000.
Mm-hmm.
How long do you have to live in a home for it to appreciate to pay the realtor on the sale of the home?
And those, I suppose, depends by the economy, where you're at, how the market conditions and all those things are. There's no set kind of thing for that, I would assume.
There really isn't.
Yeah.
And I suggest to people that they consider the non-economic factors first, things that I've just talked about. Permanence, how confident are you that you're going to stay? Do you feel that you'll be around in that house long enough for it to appreciate in value? And that's really one of the critical components. In expensive communities, buying looks like a perilous investment compared to renting.
Mm-hmm.
The factors in our own valley are significantly different. Home prices are significantly higher in Ashland than they are in Medford and Talent and Phoenix.
Mm-hmm.
The economics of those decisions can be very different based upon where people purchase a home.
Mm-hmm.
I have clients who purchase rental properties in Medford for less than $100,000.
Mm-hmm.
You can't buy bare land in Ashland for less than $100,000.
I've always heard it, and you have many clients. We're talking, by the way, with Glenn Cunningham, a CPA from Nagel and Padilla, and he's our kind of a resident CPA here on the Real Estate Show. I've always heard, and we've told folks here that from people who've been in your businesses or whatever, if you own property, that you generally are better off in your life, financially, et cetera, by owning versus the renting thing. Do you see that in clients? I mean, is that generally true that that's why we aspire to own property, to own a place to increase our value and our wealth? Is that still there?
It, unfortunately, was more important and more reliable in the past, particularly in this market when housing prices were increasing so rapidly prior to 2008, 2009, because your home became a source of wealth. It wasn't just where you lived, and something that you were proud of.
The house itself was.
It became a source of wealth. And many people...
I don't know what you're going to say. Look how many of us, and notice I said us, went into those and used the equity in those homes, didn't we?
Absolutely.
And got money.
And use that money to pay for their children's education,
whatever,
or a great vacation, or a new car. And many people ended up being on the bad side of that debt, where they had more debt than the house was worth. That situation has changed dramatically. The values aren't increasing the way that they used to. So you can't really count on that property being a source of increased wealth for you, particularly over the short term.
Even though prices, they went to that top spiral, then they dropped. We saw them all drop and things. Even though they've come back, though, it's not going to be at the pace or the rate of increase, is what you're saying, as it was. If it does, I agree, then the whole world's going to collapse again. So I hope that we don't see that type of increase. But it's as steady as you say. It's permanency. It's steady. It's being there. That's when you generate the wealth. That's when you generate what the good things of owning property is about.
Well, making the decision to buy a home is an important factor. And there are lots of reasons to buy a home that are not economic.
Okay, yeah,
and
that's
you
true.
should make the decision about buying a home with a careful balance of the economic factors, like home appreciation, and the non-economic factors, like how long do you plan to be there, and how important is it to you to have something that's on the scale of not permanent to permanent, more on the permanent side. And there are significantly larger tax outflow obligations on home ownership than on rental.
The individual pays more, right? I mean, as an individual owner, the homeowner pays more.
Absolutely.
Than the renter does for outside money.
Absolutely. And so there's a lot more unknowns. I'm a big proponent of home ownership, but believe that you shouldn't be buying a home for the tax advantages.
Just for the tax advantage. Yeah, that wouldn't make any sense. I mean, I'm sure some people do, but yeah, I agree with you there.
I mean, so if you're paying $2,000 a month for your mortgage, you're paying $24,000 a year on mortgage. Let's say half of that is interest and half of it is principal. That $12,000 that goes towards interest, only a portion of that results in a tax deduction if you're eligible for a tax deduction on it. And so you're spending $12,000 and may not have it.
Mm-hmm. Well, see, that's interesting. Well, rent and buy and all these kinds of things. Qualified home mortgage insurance premiums are changing. We've got lots of stuff still to talk about. We're with Glenn Cunningham from Nagel and Padilla. The Real Estate Show rolls on here on KMED. We'll be right back with more right after this. Real Estate Show rolls on here on KMED this weekend. Last weekend of June of 2014. Summer in the Rogue Valley and 4th of July weekend coming up. Fireworks abound, picnics, parties. Still a little bit of water in the lakes. I was by Immigrant Lake today, and it's coming down. We'll have the Steve Mason, by the way, of the WISE Water Project, the WISE Project, be with us in early August, and we'll know a lot more about the situation for the fall at that time. But boy, the lakes are starting to go down already, and here we are. It's not even July. It's a really an interesting time as we go through this, that's for sure. But boy, we'd like the rain this week. We're with Glenn Cunningham today on the Real Estate Show. He's a CPA from Nagel and Padilla, the co-owner of that company as well. And Glenn comes with us once a year. We corral him and get him up here to give us updates on tax rules and things like that for properties and things that you need to know. I want to talk to you about 1031 exchanges too, if you can, for a little bit at the end of the show, because that seems to be coming back up. I hear a lot more people talking about 1031 exchanges and if that's something that people should consider. But before we get to that, one of the things that's changing, Glenn, is the deductions. I mean, one of the things you always know about home deductions, and one of the things that governments, certainly some certain groups want to do, is take that mortgage interest deduction, and take it away, which would be disastrous for the real estate business, obviously, and everybody else. But now they've taken one of those other things away, it seems like, and that's mortgage insurance. So I have been able to take my $1,000 or whatever I pay for mortgage insurance every year, and I've been able to deduct that. Is that right?
That's correct.
But not anymore.
That's also correct. As part of the Patient Protection and Affordable Care Act of 2012,
Affordable Care Act. Okay.
Yeah, there it is again.
How are they able? I mean, it just shocks me. How does the Affordable Care Act have anything to do with mortgage insurance premiums?
Well, it was part of an omnibus package.
I'm going to omnibus somebody. Are you kidding me? Seriously, that's really true?
Yeah, it was part of a package of pluses and minuses that were negotiated between the president and Congress for the tax changes that occurred in 2012. And part of it were changes that were initially implemented by President Bush, and then at the beginning of the economic meltdown. And one of the things that was part of both of those was the opportunity to deduct qualified mortgage insurance premiums. Mm-hmm. And let me explain what that is. If you're, if you have less credit history than the average buyer, or you can afford to put less down on the home purchase and don't have any kind of guarantee on that, like a VA guarantee on the down payment, you used to be able to get qualified mortgage insurance premiums. And the government made the decision to make that deductible for taxpayers below a certain income level. Mm-hmm. That changed beginning in 2013. So if you do currently have qualified mortgage insurance, you are no longer able to deduct those premiums on your tax return.
And if I remember right, FHA loans now require you to carry mortgage insurance all the way through the loan. It used to be if you got 20% equity, that would drop. But that is not the case now in FHA loans. So it's really out there in having an effect on people. But can I still deduct like my insurance on my house, my house insurance that I paid, is that deductible, Glenn, along with anything or not?
Unless you have an office.
Unless I have an office and I
home.
can take that 10% or so of that insurance premium and I can deduct it that way.
So I'm really glad you asked that question because we didn't talk about insurance earlier when we were discussing office and home. But the in homeowners insurance is part of the deduction that's available.
Mm-hmm.
For normal taxpayers who don't have an office and home, it's considered a personal expense and therefore not deductible on your tax return.
Mm-hmm. Now, when we started our show 5 years ago, this is one of the most amazing stat of all, was about 85% of all properties closing at that time were either foreclosed properties or short sale properties, distressed properties. Now, that has obviously changed all the way around. I mean, today it's 85% the other way, that we've got. And in those early days, I used to hear people talk all the time, or different realtors talk about so-and-so had a short sale or they had a foreclosure and it was a $200,000 difference in gap, and that is forgiven. That these things are forgiven by the banks and you walk away scot-free through a foreclosure or a short sale. Are the rules changing? I'm hearing you say to me that they're not quite the same anymore either.
Well, the rules have changed, and they changed on January 1st.
And who made these rule changes?
There was a limit on the number of years that forgiveness of debt was allowed without it being included in income. And this was part of the whole package of I believe it was TARP, the Taxpayer Assistance.
The TARP.
Right.
Yeah, right.
And the up to $2 million in qualified home equity debt, which was debt that was used to purchase or improve a home. If that debt was forgiven, it was not included in your income. So what that meant was,
if I had $100,000 forgiven, that's a gain to me of $100,000 basically, but I never had to claim it on my taxes, correct?
That's correct. You didn't have to include it in your taxable
income. And now,
income.
if money is forgiven, and I will say that from what I understand, nobody has actually come back after anybody for money. So most of this money is forgiven. Correct?
That's correct. It had been forgiven on the forgiveness of debt on a primary residence. So you had a foreclosure or a short sale. For the most part, you were able, under the provisions of this law, to exclude that from income. That has changed. There are still opportunities to have forgiveness of debt excluded from income, but the bar is considerably higher.
So say if I got $100,000 forgiven, okay? I have to claim now this $100,000 on my taxes. Isn't that going to just really screw me up?
It's going to significantly change your tax bracket and the amount of tax that you have to pay.
Have you seen anybody so far come through your office and has had this situation arise where they have had the debt forgiven, but then now it's on the taxes?
Absolutely.
You have? Oh, you have? Oh,
yeah.
Okay.
And there are opportunities and situations where the taxpayer can have some of that debt or all of that debt excluded, but the bar, as I said earlier, is significantly higher. Mm-hmm. The taxpayer needs to be able to prove that they were effectively insolvent before the debt was forgiven. Mm-hmm. And insolvency means that your debts are greater than your assets. Uh-huh. So let's say you have $200,000 worth of assets, including your house, and $300,000 worth of debt, including your mortgage. You're insolvent to the extent of $100,000 because your assets are worth less than your debt. Okay. In the situation where you just mentioned, and somebody has $100,000 worth of mortgage debt forgiven, where they have $200,000 worth of assets and $300,000 worth of debt, they're insolvent to $100,000. That debt forgiveness would be able to be excluded from income.
So you exclude that there. If you're in debt, if you're on the other side,
right? So, but the bar has absolutely been raised on taxpayers. Before, you just had to prove it was your primary residence. In order to be able to take advantage of that, you need to be able to prove that you're actually in debt way beyond the value of your assets.
Well, what is the biggest margin that you've ever seen in your little world in terms of forgiveness of debt? Do you have any figure? What would tell people what would be the most you've ever seen?
The biggest one that I have dealt with recently is a taxpayer who had over $1 million in debt forgiven.
Wow.
Property had over $3 million worth of mortgages, and it was sold in a distressed situation for around $2 million.
So there's $1 million gap, and you can...
And we have not been able to close that gap yet. We're still working on closing that gap.
That's just a little bit bigger gap than most of us would have.
Yeah, you don't want to be in that situation.
Yeah, no, you really don't. Well, there's lots. It's really interesting. I mean, people need to take care of these things and be aware of what's going on around you in terms of taxes, because the worst thing you want to do is get stuck or get caught with something that you could have avoided, that's for sure. We're with Glenn Cunningham from Nagel and Padilla, CPA in Ashland, is co-owner of the business as well. We're talking all sorts of things about, well, taxes and properties and what makes sense and what's changed on The Real Estate Show. We're coming right back with Glenn after this. Welcome to The Real Estate Show on KMED this weekend. Pete Belcastro with you here, and thanks for being with us. I'm a broker with John L. Scott Real Estate, and we get together every weekend here on KMED to talk about issues facing real estate in Jackson and Josephine County. We've got a website, realestateshowOregon.com. All of our shows are also available on YouTube at youtube.com/real estate show. So please tell your friends. We appreciate that. And of course, if you need any advice, guidance, or counsel of real estate, that's free from us as well. You can write to us, Pete or Joe, at realestateshoworegon.com. Want to give you, we're with Glenn Cunningham today, for CPA here on The Real Estate Show. Want to give you a shout out to the Rotary Club of Ashland's annual Farm to Table Dinner live auction. Will be Saturday, July the 19th. 4:30 at Willow Wit Ranch. It is local food from local farmers, prepared by local chefs. And Glenn is also a member of the Rotary Club of Ashland. This is a big event. People love it. This is the thing about wanting to know where food comes from, farm to fresh food, that kind of thing. These are the new, fundraising events. It's going to be kind of cool.
It's very exciting. We're really thrilled by the response that we've had so far. We've got some great sponsors for the event. We have terrific live auction items that will be available to attendees, and a really amazing menu by A to Z Catering, which is an Ashland catering company.
That's July the 19th, and you can get any Rotarian has some tickets if you'd like to get them. You can contact Joan Williamson at 897-4079 if you want to do that, or any of us as well. That's on July the 19th. Glenn Cunningham here in the last segment. Again, 1031 exchanges, people hear about them. And they ask lots of questions about them. Is it something that I should do or should not do? And you obviously, when you prepare tax returns, I assume you see 1031 exchanges come through quite a bit, a lot?
We see a lot of them, and a lot more than in the past few years.
Really?
Yeah. And I prefer to think of them as a like-kind exchange rather than using the term 1031 exchange.
Okay.
Because like-kind exchange better defines what it is that we're talking about.
So what a 10th? Okay, whatever exchange you want to. What in the world is it? What in the world is it for people?
Well, the reason I like the term like-kind exchange is that it explains what we're talking about. If you own a commercial rental property and you have unrealized gains on that property. Say you inherited it from a relative who purchased it in 1965. That property was worth $100,000 in 1965, and now it's worth $1.5 million. Okay?
All right.
We should have both hoped for that situation, right? Well, if you sold that property without participating in a like-kind exchange, you would have a $1.4 million taxable gain. You'd have a significant taxable gain for federal and state purposes. Mm-hmm. If you want to be in the rental property market, the commercial property market, instead of selling it and then putting the money in other investments, you could sell it in a transaction and then reinvest those proceeds in the purchase of one or more like-kind properties. Say that you own, a commercial property in Medford. You own a strip mall, and you've gotten a great offer for that strip mall, and you're about as ready to sell as you ever could be. But you don't want to pay the tax on the gain, and you are interested in having the cash flow that would be available from a rental. You could sell that property and then invest those proceeds in a handful of either residential rental or commercial rental properties that would continue to produce that cash flow for you, and you wouldn't pay gain on the sale of the first tax on the gain of the sale of the first property. You would be basically able to defer that gain. You don't make it disappear. You just make it sit in abeyance.
So I can spread it out a little bit. I can buy more than one property, though, you said.
You absolutely can.
So it's having, I guess it was a great your basis point. Is that where you're starting from with this? If you get the property, it's inherited, or you buy it, you start at that point. Then when you want to sell it, it's worth X amount, and that's the difference that you're trying to make up then.
Absolutely.
Okay.
And think about a situation like this, Pete. Your parents could have owned a piece of commercial property that they purchased many, many years ago, and you were ready to sell that commercial property, but you didn't want to pay the tax on the gain.
Capital gains tax.
You like the cash flow from being a landlord. You enjoy being a landlord, and it's really important to you to not pay the tax on it. You could reinvest that into other commercial property, and an added benefit for a lot of people is that if you, and I'm sorry I'm going to be saying this, but if you plan to die owning that property and you want to leave it to your children, that property, you would effectively have sold that property, never paid tax on the gain, and then your children would inherit it at the higher value at your date of death. So you're able to build a tax planning strategy around the ownership of commercial real estate that could be really beneficial for you.
Now, it doesn't have to be commercial. I can do it on residential properties as well, these exchanges and well.
Absolutely. It could be commercial or residential.
So I don't have to live in the property. It's not like owner-occupied kinds of things like FHAs are, some of the different loans. It's just an exchange of property, exchange.
It should not be a personal property at all. A personal residence is personal property. It should be property that you are operating as a business.
As a business. That makes a whole lot of sense. We're almost out of time, and one of the things that Glenn has been able to do is that he's got a great newsletter from his company and things that just give you information. So tell us people how they can get a hold of you, because that kind of thing. Because you got to. We always tell people we want you to be a smart real estate consumer and avoid problems.
Absolutely, Pete, and we look forward to helping people do that. And thanks for the opportunity to be on the show. Our firm, Nagel & Padilla, offers a complimentary 1-hour consultation for new clients, but there's lots of information that's available for free. And that includes information at our website, www.nagelpadilla.com. There's lots of helpful resources, including calculators on making financial decisions. We also have a monthly newsletter, and our current newsletter has one article on sell your home, but keep the profits. So lots of great information available. We also have a good presence on Facebook, and you could follow us on our Twitter feed.
Hey, you got it all. You're like right uptown, aren't you, with that? That's pretty good.
Following in your footsteps.
All right. Well, now, Glenn, today, look at this. You got all this for free from Glenn. This is pretty good information. We've learned a lot, as usual. So thanks for being here, Glenn, and we'll talk with you soon. You can get a hold of Glenn at Nagel & Padilla, and they'll be able to help you in anything you can. That'll do it for the Real Estate Show this weekend here on KMD. Thanks for being with us. We're back next week about mortgage interest rates with Guy Giles from Summit Funding. Have a great week, everybody, and God bless, and we'll see you next weekend here on the Real Estate Show.
Thank you for listening to the original Real Estate Show with Pete Belcastro and Joe Brett, the Real Estate Guys. For advice, guidance, or counsel on any of our topics, or to watch a replay of today's show, visit our website at realestateshoworegon.com. This show is sponsored by RE/MAX, Ideal Brokers of Southern Oregon, Tycor Title, All Cities Property Management, and the Jackson Soil and Water Conservation District. We'll continue our weekly quest to enhance the value of your property and to make you a smart real estate consumer when we gather every Saturday and Sunday on KMED for the one and only original Real Estate Show.